Good afternoon and welcome all of you to our conversation on taxation. This is going to be an interesting one, and I'm very happy to do the honors to introduce somebody who has really been passionate about this subject. Today, let me take the opportunity to introduce you to Mr. Ravinder Singh Chawla. For the rest of the session, I will call him Ravinder ji. That will be short and sweet. Ravinder ji has been, very active in the space of learning and development, and has also been part of many industry initiatives on learning and development, management consulting. He also has been a content creator in many aspects, particularly when it comes to financial planning, taxation, and skills development. He is a double master's holder. He has a master's in economics, and then he went on to do a master's in management, and subsequently has spent almost 30 years in varied roles across corporate life as well as an entrepreneur. And let me talk a little bit about that too. In his corporate life, he's been exposed to different international and Indian companies of repute, and he has traversed a whole spectrum of industries, be it FMCG, media, office automation, or BFSI. All this, I believe, brings in a lot of perspectives when one talks about a subject. So that's a great thing to have. Besides this, another interesting thing that I observed while I was talking to him was that he's very passionate about teaching, and he is a visiting faculty in many institutions in India, and he's also authored a couple of books, or co-authored them for both the College of Insurance as well as the Insurance Institute of India. So without taking too much time from his presentation today, let me extend a very hearty welcome to Ravinder ji for today's session on taxation. Welcome, Ravinder ji.
Thank you so much, Rajesh. I'm absolutely privileged to be here. I'm proud of being, CFP and part of the fraternity. It's absolutely a pleasure. Thank you. Thank you for your kind introduction and gracious welcome. I appreciate it.
Thank you, Ravinder ji. So with this, what I will do is I will now step behind and allow you to take the main stage, and I will come back with questions as and when you prompt for it. Over to you, Ravinder ji.
Thank you. Thank you so much, Rajesh. Good afternoon to all the viewers and the fraternity members of financial planning, the CFP, the fellow CFPs. This topic absolutely is, very important, and I'll want to dwell on this particular topic. See, when it comes to tax planning, right, that is something which is very important to all of us, because at the end of the day, if we have income, we are liable to pay taxes on the income. Now, generally, it is believed that tax planning, is the forte of let's say chartered accountants, and it is only the chartered accountants who know about tax planning. Obviously, but there's no doubt about the fact that chartered accountants, they do a very important job, very good job, right? But when it comes to financial planning, as we know, tax planning is also very important part of the 360-degree financial planning, right? Now, just imagine a situation that if we want a client to be able to focus on their financial goals, and they are not thinking in terms of tax planning, or if we as CFPs, if we are not supporting the clients, understand the importance of this particular thing, or are not able to encourage the clients to proactively do tax planning, then probably we may not be able to add value in terms of our proposition. So I strongly believe that tax planning is something which, because people are not much aware about, if the CFP fraternity members, if they were to start talking about tax planning with their clients, they would definitely be able to kindle a keen desire in the clients about the need to focus on this particular aspect. And more than that, they would also be able to definitely add lot of value to their proposition, right? Thereafter, obviously, other aspects pertaining to understanding the financial goals of the clients, supporting them take care of those goals by working on strategies, etc., etc., would definitely follow course. But there are a lot of myths associated when it comes to income tax. You may have received WhatsApp messages wherein people have been circulating messages making fun of the word tax. I have read messages which say that whenever you are feeding your child, start taking away something from the child. Let's say if the child is having ice cream, then take a bite from the ice cream, or so that the child gets used to paying taxes. Now that's a negative connotation, or let's say association with tax. The fact of the matter is, as we will learn today, there are so many I would say liberties which have been given. The tax structure is so, the tax laws are so generous, I would say, that we can always pay our go about doing our business in the right manner, and at the same time do tax planning, reduce our tax liability in a very legitimate manner, right? As we know, there is a big difference in terms of tax planning and tax evasion or avoidance. Tax evasion obviously is concealment of income, and tax avoidance is adopting wrong means to be able to reduce your tax liability. But when we are talking about tax planning, that's a very legitimate way, making use of the avenues available within the Income Tax Act, and that's a right way to go about it, right? So I would be happy to keep getting your questions. We would be wanting to add value in terms of yeah, helping you clear your doubts, and that is what our intention has been. So I'll quickly share my presentation, and I'll keep talking about it. Now, before I begin, let me also share with you why have we chosen this topic pertaining to tax planning for self-employed people. The reason is this, very simply, that obviously when it comes to salaried people, there is still a lot of awareness that people have. Always, this is something which is always being spoken about. But when it comes to self-employed people, or let's say non-salaried people, uh, 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 not much awareness is there on that particular front. So we thought we will talk from the perspective of the non-salaried people or the self-employed people. So I'll quickly share the presentation. Okay. So as we know that taxes and debts are absolutely inevitable. Uh, Both are definitely going to be falling due. So let's talk about understanding what are the different heads of income. Now I'm sure you all know about it, but still just to quickly talk about it. So the first one is salary. But when we are talking about the self-employed people, uh, uh, they may not have income from salaries. There could be income from host property. Could be income from, obviously we are talking in terms of business, from income from business and profession. That is what is going to be the main part of the income in case of the self-employed people. They could also have income from capital gains, and there could be income from other sources also, primarily interest income, etc. Right now, in terms of income from business and profession, as we know that the businessmen are supposed to pay uh, tax on the profit, right? So sales turnover minus all expenses, and that would lead to profits. So the tax is liable to be paid on profits. Now, in case of small business owners, right, the government has introduced certain provisions wherein small businesses do not need to maintain any books of accounts, right? They have attempted to make things very easy for the business people, right? And they have introduced concept called as presumptive, tax on presumptive profits, right? Or presumptive tax as it is normally called as. So we shall be talking about it. We shall be also discussing it in terms of certain case studies, right? We'll try and look at it as to how should self-employed people or small business owners, how could they go about doing this tax planning? And thereafter, I'll be happy to, answer any questions that you may have, right? So these are the heads of income which we know, and broadly speaking, we are going to be mainly talking about income from business and profession today, right? Now, when it comes to tax planning, what do we mean by tax planning is taking proactive actions, right? Planning to reduce your tax liability by utilizing provisions which are available in income tax. So what do those provisions pertain to? So the first one is the first one is through deductions, right? So we'll be talking about deductions. For example, Chapter 6 deductions, Section C, 80C, 80D, right? All those. And by creating avenues for exempt income, right? So we'll be talking about all that and how should they go about doing tax planning with the help of case studies. Right? Now, as I was sharing with you that we are primarily going to be talking in case of small business owners, right? And how could they do tax planning without having to maintain books of accounts by utilizing the presumptive tax provisions, right? So quickly speaking, these are the tax slabs. As we know, we have the old regime wherein deductions are allowed, and we have the new regime, new tax regime, where deductions are not allowed. So today, we'll be primarily talking from the perspective of the old regime, where deductions are allowed, and we talk about how through deductions the tax liability could be reduced. So let's talk, in terms of the deductions. So what are the avenues in terms of deductions, right? So the first one is Section 80C. So as we know, deductions 80C would pertain to investments which could be done in ELSS, equity linked savings schemes, or let's say life insurance, or let's say public provident fund, or it could be tuition fees of up to 2 children, right? Uh, uh, 1.5 lakhs is the maximum limit which is there in case of ATC, Section 80C. The other important section, which is very, very important, is the voluntary retirement through NPS, National Pension System, right? Tier 1 of National Pension System. Now, again, this is one area where there's not much awareness in people about. So obviously, we need to sensitize people, especially the self-employed people, educate them about it, right? So they could have deductions up to 50,000 rupees, or 50,000 rupees is the maximum amount, but it is also subject to 20% of their gross income, right? So let me give an example. As long as the businessman has gross income of 2.5 lakhs, right? 20% of that is 50,000. So if that self-employed person is making contributions to NPS tier 1, 50,000 rupees would be deductible, right? But then section 80C also includes NPS. So from that perspective, if a businessman is making a contribution of 2 lakhs in NPS, right? Assuming he does not do anything else in from section 80C perspective, then also the deductible limit available would be up to 2 lakh rupees 80C plus 80CCD 1B. Of course, as I shared with you earlier, that it has to be maximum up to 2 lakh rupees 80C plus 80D in 80CCD 1B combined in case of NPS tier 1, subject to minimum 20% of gross income, right? So for example, assuming that a particular businessman is not doing any contribution in section under section 80C, wants to do the entire contribution in NPS, right? Then yes, up to 2 lakhs can be done, but the businessman must have an income of gross income of 10 lakh rupees, right? So up to 2 lakhs could be contributed in NPS tier 1 as well. But as we know, obviously, life insurance protection is also important. So we should also encourage people to manage risk by having appropriate, adequate insurance. The other thing is section 80D, which we know about pertains to health insurance, right? So there again, we have provisions for deductions available. And as we know here, for beg your pardon, for people who are below the age of 60, the limit is 25,000 for self, right? 25,000 additionally if parents are also below the age of 60. So for self and parents, the limit is up to 50,000. If parents are also below 60, just 1 minute. And if let's say somebody's parents are above the age of 60, then 50,000 would be the limit for senior citizens, and 25,000 would be the limit for the deductible maximum deductions available for the person below the age of 60. So up to 1 lakh rupees of deductions are available, considering that the self-employed person is also above the age of 60 and parents are also above the age of 60. Another important section from the perspective of deductions which could be made use of in case of self-employed people is section 80GG, which pertains to the deduction towards house rent, right? Now, obviously, the self-employed person is not going to be getting any house rent allowance. So there is a provision available, and a maximum up to 60,000 rupees in a year, this deduction is available. So we'll try and understand it with an example in case of a case study. And last but not the least, in case of the deductions are available if somebody were to take home loan, right? So this could be through loss from house property, right? So that is again another option available for deductions, right? So let's go about learning more, in case of all these deductions with the help of a case study. Okay. Now, before talking about this particular case study, let me quickly help you understand as to what do we mean by presumptive tax, right? So very simply speaking, let's take the case of a particular businessman let's say a shopkeeper, right, whose total income is, which means the total turnover of the businessman, let's say, is 1 crore rupees. Right? That's a total top line. The total sales turnover of a person. Right now, as I shared with you earlier, this person is supposed to be liable for taxes on profits, which means the person is supposed to be maintaining books of accounts, get those books audited, right? But the government has given this facility to small business owners whose income is below 2 crores. Right now, there are certain exceptions there. For example, business owners, does not include people who are having agency business or people who have income through commissions, right? So there are 3 sections that we'll talk about. One section is called as section 44AD. One is section 44AD. So here, who could get these? Who could be covered in this? It could be individual, resident individual. It could be partnership firm also, resident partnership firm, but LLP is not included, right? And also within section 4480, HUF is also eligible, right? So resident individual, resident HUF, and resident partnership firm, excluding LLP, right? Now, if this individual or resident HUF or resident partnership firm, excluding LLP, if they have income of up to 2 crore rupees in a year, right? Then they can straight away compute 92% of their turnover as expenses, right? So 92% of the turnover could be presumed to be the expenses, right? Which means 8% of the turnover would be the profits. So 8% would be profits in case the turnover is also from non-cash, not from cash sources, right? So let's say a businessman is getting revenue in both cash as well as digital mode, right? In that case, 8% would be considered as profit, right? Would be deemed to be the profit. That's as per the presumptive tax scheme, right? But if let's say the businessman gets all money from banks through bank account or through digital medium, right? Then in that case, as low as 6% only would be considered as profit, right? So assuming that the turnover of the business is 1 crore and this person is getting all revenue in terms of digital mode, maybe bank, or let's say credit card, debit card, or let's say UPI, right? Unified payment interface, Google Pay, Phone Pay, etc., etc. Then in that case, just 6% would be presumed to be the profits, right? I mean, it's so lucrative. So let's look at a case study. Now, in the case of Vijay Dinanath Chauhan, his revenue is both in terms of cash and non-cash sources, right? So that is why 92% of the turnover would be deemed to be the expenses, and 8% of the revenue, which is 8 lakh rupees, would be deemed to be be deemed as profits of this particular company, right? So 8 lakh is the income. 8 lakhs is the income, right? Obviously, if this person does not do any tax planning, if he does not avail of any deductions, then the income would be liable for taxes at the rate of 8 lakhs, right? But as I shared with you earlier, if Vijay had been collecting all his revenue through digital mode, right? There was no cash element. Then the income, the taxable income, would have been as low as 6 lakh rupees. rupees, 6% of the turnover. Right now, Vijay Dinanath Chauhan is a smart gentleman. So what he does is that he does tax planning, right? So what he does now normally as per 6 lakhs, right? Oh, sorry, 8 lakhs, assuming income is 8 lakh rupees, the tax liability would have been 72,500 as per the old regime, right? So from 2.5 lakhs to 5 lakhs at the rate of 5%. So that would have been 12,500, right? And on the balance 3 lakhs at the rate of 20%. So additional 60,000 on that, 60,000 plus 12,500, the tax liability would have been 72,500 plus cess 4%, right? Now, can he reduce his tax liability even further? Yes, he can do that, right? And that is what Vijay Dinanath did. So let's look at what he could have done, what he would have done, right? So what Vijay does is he is able to bring down his tax liability, taxable income. He is able to bring his taxable income down from 8 lakhs, right? How? He invested 1.5 lakh rupees in those avenues which were eligible for ATC deductions, right? So it could have been ELSS, it could have been, tuition fees, it could have been public provident fund, right? It could have been NPS also, right? Insurance policy, life insurance policy, right? Additional 50,000 rupees subject to 20% of gross income, right? Maximum 50,000 rupees could have been the deductions through contributions to NPS tier 1, right? So additional 50,000 is available there. Plus what he also does is he buys health insurance, right? For him and his parents, and he is paying a premium of, let's say, total premium of 40,000. Right? Plus, as I shared with you earlier, since he is staying in a rental property, right? So he is also eligible for maximum 60,000 rupees, 5,000 per month, right? In case of the rent paid, towards the rent paid, right? So these are the deductions which he makes use of. Okay. So what are the total deductions? 1.5 lakhs plus 50,000 is 2 lakhs plus 40,000 plus 60,000. Total, he is able to have deductions of 3 lakh rupees. Right now, his original taxable income was 8 lakh rupees. Right, the profits were 8 lakh rupees. The deductions are 3 lakh rupees. Right, which means now he is able to get his taxable income reduced to 3 lakhs. I beg your pardon, 5 lakhs. Right, he's able to get his taxable income reduced to 5 lakhs. Right now, as you may be knowing, there is another section called Section 87A. Section 87A, wherein a rebate in terms of tax liability up to 12,500 is available, which means if the tax liability, if the income is up to 5 lakhs, right, then the tax liability of 12,500 up to 12,500 gets waived off, right, which is what happens in this case. And actually, Vijay is not liable to pay any taxes, right? So Vijay is actually able to reduce his tax liability by 75,400, including cess, right? So that's the provision. That's the advantage which he's had. He's been able to reduce his tax liability in a very legitimate manner, right? So he is proud of the fact that he is absolutely following the norms. He is, doing everything in a correct manner. Okay, one thing here very important. In presumptive income, it is very important that the assessee should have paid the advance tax, right? So in this case, Vijay was supposed to pay tax of 72,500, ideally speaking, by March 15th, right? and then file his returns and claim a refund, right? So ultimately, whatever advance tax he would have paid, he would be getting refund on that, right? So it is important that the assessees, they keep paying their advance taxes. As we know, that there are slabs applicable. For example, 15% of advance tax ought to be is supposed to be paid by 15th of June. 45% is supposed to be paid by 15th of September. 75% of the year's tax liability is supposed to be paid by 15th of December, and the balance was 100%, total 100% is supposed to be paid by 15th March. Unless and until he would have planned his tax liability at the beginning of the year itself, right? In that case, he can always say that I have been doing my investment, so that is why my tax liability was would have been zero, right? But the fact of the matter is that with sales turnover, nobody would be able to do that precise projection that at the beginning of the year itself, the person says that I know that my income will not be more than, my turnover will not be more than 1 crore, right? It's very, very difficult. So that is why it is important that the assessee pays, appropriate slabs of advance tax, and later on at the end of during the assessment year, files the tax returns and gets a refund, right? So the refund would be coming, because this is as per the provisions of the Income Tax Act, right? Let's look at another case study. So let's now assume that next year Vijay's turnover increases by 15%, right? So the turnover rises from 1 crore to 1 crore 15 lakhs, right? And by this time, Vijay has also bought his own house. He's moved into his own home, right? Now the turnover is 1.5 crores. Okay. So as per 44 DA section, what is the tax presumptive tax? 92%, right? So it would be 1 crore 5 lakhs would be the 1 crore 5 lakhs 80,000 would be the expenses, deemed expenses, and 8% of the turnover, which is 9 lakh 20,000, would be the deemed profits, right? So now the taxable income before deductions, the gross income in terms of the net income is 9 lakh 20,000, right? Before deductions. Okay, so he is also going to be making use of deductions, right? So normally his tax liability would have been 96,500, right? So from, as we know, first slab 2.5 lakhs to 5 lakhs is 12,500, right? From you just keep writing it here. So from 2.5 lakhs to 5 lakhs at the rate of 5% would have been 12,500, right? And on the balance 5 lakhs to 9 lakh 20,000, right? At the rate of 20% would have been the balance. So the total one would have been, as we would see, the total liability would have been 96,500 plus cess, right? But let's see, how does he manage to reduce his tax liability through deductions, right? So let's look at it. So what he does is that he pays, he avails of deductions of 1.5 lakhs through ATC, right? He avails of 50,000 rupees of deduction for contributing to ATCCC. I beg your pardon, ATC City 1B, right? NPS Tier 1. He's also paying a health insurance premium of 40,000 rupees, right? As we learned earlier. This time, because he's also taken a home loan, right? he is also able to get a deduction of 2 lakh rupees on account of loss from house property. Right? So we will learn about it. How did we arrive at this 2 lakh rupees of loss? Right? How has this deduction come to 2 lakh rupees? We will look at it in the subsequent slide. Right? So the total deductions now are 1.5 lakhs plus 50,000, 2 lakhs. Right? 2 lakhs towards the loss from house property and 40,000 towards section 80D. Correct? So total deductions that he is eligible for are 4,80,000. Right? Now, just remember that his income was supposed to be 9,20,000. He's now eligible for additional deductions of 4,80,000. Right? So Vijay is being able to practically get his tax liability to zero, and therefore he's been able to save 1,03,360 including cess. Right? Now that part, remember, now his taxable income is 4,80,000. Right? So his loss from house property was actually higher, as you will see in the next slide. Right? But he is entitled to use only maximum 2 lakh rupees in a particular year. Right? So now he is able to carry forward the additional. He's utilizing only a certain portion of the loss from house property. 20,000 rupees would get carried forward to the next year. The additional 20,000 loss on account of house property gets carried forward to the next year. Right? And actually it could be carried forward to up to 8 assessment years. So next year also, if he doesn't utilize it again, he could do that next year. So this can happen up to 8 assessment years. Right? We will come to the calculation on loss from house property very shortly. But let's look at another case study. Right? Now I want to introduce to you another section, which is 44 ADA. Now, this is in case of professionals. So lawyers, doctors, right? Architects, right? All those professions. Here in this case, the presumptive tax, right? 50% is can be presumed to be the expenses. So in case of professionals, 50% of expenses, a maximum 50% could be deemed to be the expenses. They don't need to maintain any books of accounts. They don't need to get the books audited, right? They can straight away presume that my expenses are 50,000 rupees. They are not supposed to avail of any more expenses beyond 50%. Right? So because Dr. Jigna is a doctor, right? She is a senior citizen, as we have assumed in the case. Let's assume that her income is 15 lakh rupees in a year. Right? Now, because the deemed expenses have to be 50%, in her case, the deemed expenses are 7.5 lakhs, right? So net income would presume to be 7.5 lakhs, right? Now, if she does not avail of any deductions, the tax liability would be on 7.5 lakhs. Right? So as per the old regime, the tax liability comes to 64,400 inclusive of cess. But let's see, how does she manage to reduce her tax liability through planning? Okay? She's a senior citizen, right? She's more than 60 years of age. So 1.5 lakhs is to ATC, right? Now she's also making contribution to NPS tier 1. So 50,000 rupees is the limit applicable for ATC CD 1B, right? Because she's a senior citizen, she is entitled to 50,000 rupees of deductions in case of health insurance premium for herself, right? Let's assume that her parents are not there, so she is only paying premium for herself, right? Which means the total deductions applicable are 2.5 lakhs, right? Now the income, the profits of her business were 7.5 lakhs. So now she is able to get deductions of 2.5 lakhs, which means her taxable income has come down to 5 lakhs, right? So again, in her case, because of Section 87A, the rebate available, the tax liability has come to zero, right? Dr. Jigna was also able to, save phenomenally in terms of the tax liability. So let us quickly understand, tax calculations through house property, right? How does income or loss from house property get calculated? Okay, so let's imagine that Ashok Patankar has a flat which he has let out, right? Now let's imagine that he has taken a home loan of 50 lakhs and he's paying interest at the rate of 7.5% on that. Okay, and the rent of the property, because he's let it out, is 50,000 rupees per month. So in a year he's getting 2,40,000 of the rent in a year, right? So that is what is the gross annual value of the property. 20,000 multiplied by 12, 2,40,000, right? Now let's imagine he is paying municipal taxes or property taxes of 30,000 rupees in a year, right? So 2,40,000 minus 30,000, 2,10,000 is the net annual value of the property, right? Now he is eligible to avail of standard deduction of 30%, 30% of the net annual value, right? So that comes to 63,000. So this is deductible. Similarly, he's also paying interest at the rate of 7.5% on 50 lakh rupees of principal, right? So in a year, he's paying interest of 3,75,000, right? So the loss from house property here, because the outflow is more than the inflow, this will be a loss. So what's the loss from house property? Net annual value minus standard deduction plus the interest amount paid, right? So in this case, the actual loss which comes is more than 2 lakhs. But then in a particular year, the maximum loss from house property that could be claimed is only 2 lakhs, right? So because the loss was actually 2,28,000, in a year he can claim only 2 lakh rupees as loss from house property, right? And that would reduce his total taxable income, just like we saw in previous case, right? And the balance 28,000, which is not availing of in this year, would get carried forward in the subsequent years, right? Up to 8 years it would be carried forward, right? And next year it could be availed of, against income from house property, right? So this is how it would work. Let me check out the questions and let me take some questions, and thereafter, we'll take further. What about ATE, ETG? Yes, perfectly right. So, there are certain sections which are provided in income tax. So very good question. Somebody is asked, what about ATE, ATG, ATGG, etc. So ATGG we have already considered, right? ATE is towards educational loans, so that would also be eligible. There are certain sections, for example, ATHH. So ATHH is for example, for hotels, restaurants, etc. If they set up businesses, then certain deductions would be, they could avail of certain deduction. So those people will not be able to, avail of this particular presumptive scheme, right? So because you cannot have your cake and eat it too, right? So ATHS to ATRRB, For example, let's say somebody has set up an export oriented unit, or let's say software export zone, or let's say somebody is having royalty income for having written a book, right? All those people who have been availing those deductions, they may not be able to avail the presumptive scheme, but section 80G to 80, 80U, all those sections which are there, the most popular ones, 80C, 80D, 80E, donations, 80G, right? 80GG, as we discussed, section 24 towards home loan, those are eligible. Okay. Will term insurance come under 80C or 80D? Term insurance comes under 80C, right? Health insurance and critical illness insurance, that comes under 80D. Okay. How much proportion of cash and bank should be considered as expense? So even if, let's say, theoretically speaking, even if I am getting 1 rupee of cash income, right, then for me, the presumptive tax, the expenses have to be considered at 8%, right? Even if I'm getting 1 rupee. But let's say if in my business I'm getting 100% of my turnover in the form of digital means, bank account or debit card, credit card, UPI, etc., then only it can be 6%, right? It has to be 100%. So that is why it is very important. Somebody should not try to, do something wrong, right? Only and only if it is 100% from digital means, then only it can be 6%. Financial planners also under 40 ADA. Say if we have income in the form of commissions, right? If let's say if we have income in the form of commissions, or let's say agency income, no, then it is not 40 that 8% thing is not allowed, but so that's very important, right? It very clearly says, but yes, 50% presumptive as professionals. Obviously, we would be professionals. Yes, we can do that. Any more questions? Yeah. So I think questions are welcome. Okay. Now, important thing is. Other thing important is, very importantly, how can we add value, is we need to encourage people to start investing money, right? And people could also avail of exempt income. They could try and create exempt income, right? For example, investments in equity would really help people to be able to create exempt income of up to 1 lakh rupees, right? Because as we know, the long-term capital gains of up to 1 lakh rupees are exempt, right? So we need to reach out to people. We need to help them understand this concept of tax planning, encourage them to start investing, let's say, ELSS, etc., right? And they can also try and create exempt income, right? Because equity, is one asset class which is very, very tax efficient. Right, up to 1 lakh rupees of exempt income in a year is, I think, quite decent. So that is something which people can avail of. And very importantly, it is also important that the period for the computation of long term is very less in equity, just 1 year, just 12 months. Right? So if they are investing for more than 12 months, although equity markets would give much better returns, as we know, if people are investing from a long-term perspective, but still just 1 year of investment, and it would be classified as a long-term capital gains. So that's quite advantageous. The other important thing from a tax planning perspective is the set-offs. Right? Set-offs and carrying forward of the losses. So, for example, as we shared earlier, if somebody has lost from house property, right, that would mean that even the interhead adjustment of set-off is possible. So loss from host property could be set off, towards the income from other heads also, right? So whether it is income from any other head, it would be adjusted. So that is why it is also important that we may also encourage our clients to take a home loan, right? And maybe buy a house. Very, very important, right? Because this is something which not many people would know of, that loss from house property, even if it is just limited to 2 lakh rupees in a year, right? It would also help us reduce our overall tax liability. Okay? I'll be happy to answer any questions that we may have. If there are any questions, I'll be happy to answer. I wanted to keep some slot for question and answer. Another important thing, there is another section called as section 44DE. That's for people who have a fleet of, goods, let's say trucks, right? Goods for carriage. So again, there also, some kind of presumptive tax scheme is available. So that's again very simple. If let's say it's not a heavy transport vehicle, then they just need to consider income of 1,000 rupees in a year per vehicle, per truck, subject to maximum of 10 trucks that they have. Right. So let's take an example. Let us say somebody has small, not heavy transport, right? Not heavy duty, let's say the heavy trucks, right? So heavy means anything which is 13,000, 13 tons, 13,000 kgs, right? So if it is below that, then the presumed income will just be 1,000 rupees per month, right? So let's say somebody has got 10 small trucks, right? So 1,000 rupees per month. So 12,000 rupees per truck in a year multiplied by 10, right? So the total income will just be 1,000 rupees per month, 12,000 rupees plus 10 trucks. It would be very, very nominal, right? And let's say in case of the other, if there are heavy transport, heavy vehicles, then it is at the rate of 7,500. Oh, I beg your pardon, I made a mistake. The presumed income will be 7,500. 7,500 in case of small vehicles, right, per month. So 7,500 multiplied by 10 trucks, that would be the monthly income, multiplied by 12 in a year. And if there are heavy vehicles, then it is 1,000 rupees per ton, right, multiplied by the number of vehicles which are there, subject to maximum of 10. So that's in case of people who have very heavy, people who are in the transportation.
Some interesting questions also, Ravinderji.
Right.
You did cover quite a lot of ground in a very short time, and that was equally, I mean, a lot of notes to make for a studious learner of taxation.
Thank you.
Thank you for that. Some questions that were coming up, and I believe, one that is on screen is on presumptive taxation, which is the 44 ADA, right? So I'm not quite sure, I mean, I believe the income tax department keeps notifying the professions, but have they notified financial planner or investment advisor or any such profession yet? Might be an equal learning for me too.
Honestly speaking, even I did not see that, but I'm just talking from the perspective that being professionals ourselves, ideally speaking, it should be part of the profession. I did not see any notification.
Any notification?
Just pertaining to financial planners. but I'm presuming, and that's a presumption. And thank you so much for pointing it out. So let me add this disclaimer there that that's to the best of my knowledge. Uh, there could be, a difference in opinion on that.
Okay.
Because they're also professionals, I think 50% is something which people should be allowed, considering that they would have a lot of expenses to take care of.
Absolutely so. So, I mean, any simplification for the sake of the profession is always welcome.
Yes. Yeah. See, the whole objective is the whole objective in this case, and I think government has done a very good job there, that they have absolutely made it very easy for people to comply with taxes without having any fear, right? So they don't need to, even think of concealing their income. They can hold their head high. They can say that I am absolutely, recording. I'm paying taxes absolutely as per what I am supposed to be paying as per the norms. 10% of adjusted gross income less all deductions.
Did we?
Is adjustment here gross income less all deductions? So the 10% norm is applicable in case of the corporate NPS, for example. So there, let's say in corporate NPS, the contribution which is eligible for tax deductions is in terms of the salary plus PA which is available, right? But in case of NPS, for example, in case of self-employed people, it is 20% of gross income, right? So I think it would be 20% of gross income and not something else in mind, to the best of my knowledge. A disclaimer here, it's quite possible that there may have been some change there, because obviously it's a very, very dynamic thing. But whatever I've spoken about today is to the best of my knowledge.
Yes.
So I must point it out.
I think before we have a couple of minutes, and probably I thought it's worth taking that 2 minutes to bust the myth. We did, touch this subject in some of the earlier conversations as well. That there is a perception that if any income is being subject to tax, then that income or the asset class that contributes to that income is a legit asset class. And particularly in the context of the recent budget announcements on the crypto or the digital, assets related transactions, there is this wide perception that just because there is an income tax applicability on the gains, the whole income or the whole asset class seems to be validated from a legal perspective.
Very good question. Very good question. No, actually, it's not like that. If let's say, let's talk about, for example, horse racing, or for that matter, any other form of, gambling which could be there. No, that's illegal. That's not legal. But any other kind of, things which are not allowed. But let's say if I have income and I'm paying taxes on that, does not make it a legitimate profession. Same in the case of VDAs, virtual digital assets. What has been announced, what the government has said is that 30% would be the tax applicable on that. It cannot be set off. It cannot be carried forward, right? But that does not mean the government has approved of VDAs or what is called as the cryptocurrency. So very good question. I'm glad you asked that.
I think we are bang on time. It's 4 p.m. And I must say, Ravinder ji, it was certainly a lot to learn today with your session. We
Thank you.
hope to have you again, covering more topics in this area, and I look forward to that. And for all the viewers tuning in from different parts of the country, and for those who would watch this and catch this recording later, please make your notes and do well in your assessments on tax planning.
Thank you. Thank
All
you,
the
Ravinder.
best.
Thank you.
Thank you, Ravinder ji.
Thank you for having me here, and best wishes to all the fraternity members. Tax planning is something, which we need to reach out to the clients for. We could do seminars, and that is how we could really help them do the planning. And I'm sure our fraternity members will be doing that. Thank you so much.
Thank you. Bye.